How to implement static hedging with options. If you are curious about how to effectively manage risk in options trading, you might want to learn about static hedging. This method allows you to create a strategy that does not require constant adjustments. So, how can you implement static hedging with options? Let's break it down step by step. First, you need to identify the target option you wish to hedge. This could be any type of option, such as a barrier option or a long-term option. Knowing exactly what you want to protect is the first step in this process. Next, you will select a set of options that can replicate the payoff of your target option. For instance, if you have a barrier option, you might consider using a combination of European options. These options should be chosen carefully to ensure they match the desired payoff structure of your target option at maturity. Once you have your replicating options, it is time to construct the hedge. A common strategy involves being long one put option while being short calls at different strike prices. This setup should be designed to closely mimic the payoff of your target option. One of the biggest advantages of static hedging is that it does not require frequent rebalancing. Unlike dynamic hedging, which demands ongoing adjustments, static hedging allows you to set up your hedge at the beginning and leave it unchanged until the options expire or a specific event occurs. This makes it a more straightforward approach, especially in volatile markets. Static hedging can also help reduce transaction costs. Since you are not constantly buying and selling securities, you can save on fees that would otherwise accumulate with frequent trading. This is particularly beneficial during times of market stress when liquidity may be low. Additionally, static hedging is particularly effective for barrier options. These options have payoffs that depend on whether the underlying asset reaches a certain level. By using static strategies with European options, you can effectively hedge against the risks associated with barrier options. In summary, implementing static hedging with options involves identifying your target option, selecting the right replicating options, constructing your hedge, and enjoying the benefits of a strategy that requires minimal adjustments. This method can be a practical and cost-effective way to manage risk in options trading.